Many Canadians are asking the same question right now. Should I wait for interest rates to drop? Or should I move ahead with my home purchase or mortgage strategy today? In this video, I'm going to give you a clear, data-driven answer. Based on more than 50 years of interest rate history, current Bank of Canada policy, and what that means for you in Ontario. Who this is for. If you're a first-time home buyer in Ontario, a current homeowner thinking about refinancing, or you're coming up to renewal and wondering whether to wait, this message is for you. It's also for real estate agents who want a confident, credible way to talk about interest rate trends with their clients. Here's the big picture. We are heading into a new normal for mortgage rates in Canada. Over the next 5 years, the most likely range for 5-year fixed mortgage rates is around 4 to 5%. Not the ultra-low, emergency level rates of the COVID era, but also not the painful 6 to 7% levels we saw in the recent tightening cycle. Think of today as a reset toward a more sustainable middle ground. Right now, the Bank of Canada's policy rate sits in the low twos. Most credible forecasts suggest it will stay close to this level through 2026 and only gradually move toward the 2.5 to 3% range as we approach 2030. When you translate that into actual mortgage products, you get a very different picture than what we lived through in 2022 and 2023. Over the next several years, the most realistic estimated scenario can be seen as 5-year fixed mortgage rates may be hovering roughly between 3.8 and 4.9%. Many qualified borrowers will likely land in the low to mid-4s, and 5-year variable rates expected to be tracking somewhat lower at first, but gradually shall be rising into the high 3s to low 4s as policy rates normalize. That's the environment we're heading towards. Why history matters. Quick tour. To really understand why this matters, we need to zoom out and look at history. In the 1980s and early 1990s, mortgage rates were often in the double digits. We saw 5-year fixed mortgages above 11, 12, even 13%. The Bank of Canada was deliberately pushing rates very high to crush runaway inflation. Then, in the late 90s and early 2000s, Canada adopted a formal 2% inflation target. As inflation came under control, policy rates and mortgage rates came down too. By the mid-2000s, typical 5-year fixed mortgages sat in the 5 to 6% range, still much higher than what we saw in the COVID era, but far lower than the 80s and early 90s. Then came the global financial crisis. The Bank of Canada cut rates to near zero, and over the decade that followed, we normalized to a world of very low borrowing costs. COVID took that to an extreme. Policy rates went back to emergency levels, and many Canadians locked in 5-year fixed mortgages below 2%. That was never a permanent state. It was a crisis response. What went wrong in 2022 to 2024, and why rates spiked? So what happened next? Massive fiscal and monetary stimulus combined with supply chain disruptions and a surge in housing demand pushed inflation dramatically higher. Add the war in Ukraine, so energy price spikes and global supply issues plus inflation in Canada moved well above the 2% target. The Bank of Canada had one job: bring inflation back under control. To do that, it raised the policy rate from near zero to around 5% in a very short period of time. That's why, in 2022 and 2023, we saw 5-year fixed mortgage rates jump into the 6 to 7% range. The goal was not to punish homeowners, the goal was to restore price stability. Where we are now, and why it's different. That brings us to today. Inflation has cooled significantly and is now much closer to the 2% target, but it's not so low that we need another round of emergency rates. The Bank of Canada has already eased back, bringing its policy rate down into the low twos. From here, it has room to move a little lower or a little higher, depending on how inflation and growth evolve. The key point is this: the bank doesn't need to go back to zero unless we see another severe global crisis. It also doesn't need to push back up to 5 again unless inflation flares out of control. That's why the most probable path forward is a relatively narrow corridor rather than dramatic swings. Are the same patterns showing up again? Are we seeing the same patterns today that we saw in past cycles? Yes and no. Yes, in the sense that the bank is still targeting 2% inflation. It raises rates when inflation runs hot and it cuts when inflation cools. But today's world is more complex. We have ongoing geopolitical risks, tariff and trade tensions, and an economy that's very sensitive to both housing and exports. That means the bank is cautious about moving too fast in either direction. The result? A more balanced, middle-of-the-road interest rate environment. What this means for Ontario first-time buyers. Let's bring this home to Ontario and speak directly to first-time buyers. If you've been waiting, hoping that mortgage rates will fall back to the 1 point something or 2% range, you are probably waiting for something that is not coming back anytime soon. Those ultra-low rates were an emergency tool for an extraordinary crisis. What is far more realistic over the next 5 to 10 years is 5-year fixed mortgage rates in the low to mid 4% range, with occasional moves above or below that band. So here's the key question. Are you postponing your life for a rate environment that may not exist again for decades? Because in the meantime, you're missing years of principal paydown, potential price appreciation, and the stability of home ownership. Today's mid 4% world can still be very workable with the right home price, the right structure, and the right plan. What this means for current homeowners and renewers. Now, for current homeowners, especially those heading into renewal, if you locked in at 2% during the COVID era, anything in the 4s will feel painful by comparison. But we need to compare not just to your past rate, but to your future reality. If the base case is a 5-year fixed in the low to mid 4s today, and a gradual drift toward the mid 4s to low 5s by 2030, then waiting and hoping for a huge drop could easily backfire. For many homeowners, renewing or refinancing at today's mid 4% levels is actually a good risk management decision. It gives you certainty, protects you from a renewed inflation flare-up, and allows you to plan your cash flow with fewer surprises. Variable rate strategies can still make sense for clients who are comfortable with risk and have room in their budget, but they should go in with eyes wide open. Over time, those variable rates are likely to drift up as the policy rate edges toward its longer-run neutral level. Message for real estate agents. If you're a real estate agent, here is the simple framework you can use with your clients. First, stop framing today's rates against the artificial low of 1 to 2%. That era was an outlier. Second, frame today against the much longer history where 5 to 7% was normal and 11 to 13% was not unheard of. Seen through that lens, 4 point something percent is not a crisis level. It's actually a reasonable compromise between borrower affordability and long-term stability. Third, remind clients that the real risk is not usually 0.1% up or down in rate. The real risk is buying the wrong property with the wrong payment structure for the wrong reasons. Let's synergize so we shall be able to help them get those fundamentals right. So what should you do now? If you're a first-time buyer in Ontario, get pre-qualified at current rates. Stress test your budget at slightly higher payments. And if the numbers work, focus more on the right home and long-term fit than on squeezing out a tiny rate edge if you're a homeowner approaching renewal. Review your options 3 to 6 months before renewal. Consider whether a 5-year fixed in the low to mid-4s fits your risk tolerance and cash flow needs, and look at whether consolidating higher interest debt into a well-structured mortgage might improve your overall financial position. If you're a real estate or mortgage professional, use this middle of the road rate outlook to reset expectations with your clients. Let's position ourselves as the guide who cuts through the noise, and let's help them make decisions based on probability, not headlines. My name is Susanta Acuresa from Haystacks Mortgage RH. Our job is not to guess where rates will be next month. Our job is to understand the full cycle, use history and data intelligently, and build a mortgage strategy that works in the real world we actually live in. If you'd like to talk about how this outlook applies to your specific situation or to your clients, reach out anytime. Let's build a plan, not a gamble.